After introduction to banking, the next logical step is to discuss types of the banks. As discussed earlier, banks can be classified across different categories based on multiple criteria. For example, depending on whether the bank is owned by government or not, banks can be classified as public sector bank or a private sector bank. In this module, we will see classification of the banks based on their activities and products and services that they offer. We will discuss types of banks and functions of these different types of banks. Depending on the products they offer, some of the types of banks are 1. Universal bank, 2. Development bank, 3. Payment bank, 4. Small finance bank, 5. Cooperative bank or credit unions, 6. Investment banks. Let us now understand them in detail. Universal banks are the type of banks where almost all financial products and services are offered under one roof. These may include commercial banking, investment banking, development banking, insurance services, etc. We may call universal banks as a supermarket of the banking. Like all products across categories are available in a supermarket like D-Mart or Walmart, universal banks also offer variety of financial products and services. If we go by the definition given by the World Bank, in universal banking, the large banks operate extensive network of branches, provide many different services, hold several claims on firms, and participate directly in corporate governance of these firms that rely on the banks for funding or as insurance underwriters. Difficult, isn't it? You may not be aware of all the terms used in this definition, but do not worry. If you understand the concept that universal banks offer multiple types of banking services under one roof, you are good to go from the context of this course. Some of the famous global universal banks are Citibank, Barclays, etc. In India, State Bank of India is one of the biggest universal bank. Due to multiple product offerings, universal banks can get benefited from the economies of scale. This further reduces the cost of products and services for the clients. Let us see some of the advantages of universal banks. 1. Increased diversion and increased profitability. Because universal banks have business interests across industries, client types, and geographical regions, they will not get badly impacted by recession in a particular country or industry. They can also increase profitability by leveraging on presence of one line of business to boost another line of business. 2. Better resource utilization. Universal banks can optimize their resource utilization by various departments of the bank helping each other mutually. For example, a salesperson specialized in credit card business can also collect insurance related requirements of the client and pass that lead on to the insurance department. 3. Brand name leverage. If a bank is a leader in, let's say, credit card segment, then this brand value helps when the same bank starts a new business, for example, in investment banking. 4. Existing clientele leverage. By exploring needs of various banking services in the existing client group, banks can earn more revenue per client. 5. Value added services. Many clients are willing to pay for value added services such as dedicated relationship manager, discounted transaction cost for bulk deal, etc. Due to large client base, universal banks can earn significant revenue by offering value added services across the product portfolio. 6. Saving of transaction cost. Universal banks can use common infrastructure, software tools, human resources, etc. across departments. This helps in reducing transaction costs. 7. Easy marketing. The bank's marketing team can optimize the marketing cost by designing campaigns that targets larger customer base utilizing various services of the banks. 8. Profit diversification. As mentioned earlier, universal banks have presence across client types such as individual and corporate clients, across product types such as insurance, mutual fund, core banking, etc. This helps them earn profit from diversified areas and protects from failure of a single source of income. Development banks. Development banks are multi-purpose financial institutions with a broad economic development outlook. Rather than profit earning, their primary goal is to promote economic development in general with a focus on a few selected sectors. These banks do not accept deposits and are generally supported by the governments. Some of the long term goals of the development banks can be sector specific investing, socially responsible investing, impact investing, etc. Let us understand these terms in detail. 1. Sector specific investing. Some development banks are established to help sectors such as housing finance, agriculture financing, etc. So these banks provide financial assistance in the form of loans, underwriting, guaranteeing, etc., to the businesses in those sectors. 2. Socially responsible investing. Socially responsible investing refers to investing or helping businesses that have positive impact on the society. For example, development banks may provide loan with a lower interest rate to a business that is going to provide education at a lower cost to underprivileged children. 3. Impact investing. Impact investing refers to investing to generate better social and environmental outcomes. For example, development banks may want to provide services to companies with negative carbon footprint. Some of the examples of development banks are NABARD in India, NetBank in the USA. NABARD aims to help rural and agriculture sectors in India. NetBank aims to support infrastructure projects in North America and Mexico. Payment banks. Payment banks are comparatively recent innovation by the banking industry. These banks mainly focus on providing payment services such as bill payments, money transfer, remittances, etc. While payment banks are allowed to accept deposits up to a certain threshold, they are not allowed to offer loans or issue credit cards. They are also allowed to offer debit cards, net banking, and third party fund transfer facilities. Their main goal is to provide reliable digital payment services to small businesses, low income households, migrant labor workforce, etc. As payment banks are not allowed to offer loans, they cannot earn by accepting deposits at a lower interest rate and offering loans at a higher interest rate. Payment banks earn money by charging merchants for providing payment services, investing money received in the form of deposits in government offered securities, by offering insurance, mutual funds, and other services on behalf of their strategic partners, etc. Airtel Payment Bank and Paytm are popular payment banks in India. Small finance banks. Small finance banks are a type of niche bank in India. Their main purpose is to provide basic banking services such as deposits, small loans, etc., to those who are not served by conventional banks. Their major customers are small farmers, micro industries, and other unorganized sectors. Existing non-banking financial companies, microfinance institutions, and local area banks are allowed to set up small finance banks. They need to have capital of minimum rupees 100 crores, that is 1 billion INR. AU Small Finance Bank, Capital Small Finance Bank are some of the recently opened small finance banks in India. Cooperative banks. Cooperative banks are small sized financial entities in which most of the members are both the owners and customers of the bank. In some countries, these banks are also called as credit unions. As the name suggests, the idea is mutual help among members rather than high profit earning. Cooperative banks serve local communities, people from the same business fraternity, etc. They provide basic banking services and tie up with other conventional banks for advanced services like big ticket loans, third party payment service, and other banking services. Saraswat Cooperative Bank, Cosmos Cooperative Bank are some of the established cooperative banks in India. Globally, Alliant Credit Union, Customers Credit Union, and London Community Credit Union are leading cooperative banks. Investment banks. Investment banks are banks that serve as intermediary and advisors for large and complex corporate transactions. Generally, leading conventional banks have separate investment banking division. Some of the transaction types that they support are 1. IPO. IPO is offering shares of a company in the form of initial public offer. 2. Merger. Merger is two or more companies getting merged to make a single large entity. 3. Acquisition. Acquisition is one company buying out another company. 4. Corporate financing. Corporate financing is providing high ticket debt for long term projects, optimizing capital structure of the companies, etc. Debt restructuring. Debt restructuring is a mechanism for companies to re agree terms for paying bank loans such that it becomes easier for the companies to repay the debt. JP Morgan Chase, Goldman Sachs, Morgan Stanley, SBI Caps, Kotak Mahindra Investment Banking, Credit Suisse, UBS are some of the leading Indian and global investment banks. With this, we have reached to the end of this module.